In the next section, we will have a look at notes payable. We studied notes receivable in a previous chapter. Notes payable are basically the opposite side of a notes receivable, and the accounting is very similar. Does that make any sense? My advice is when you are given a set of facts for an exercise or are told that a transaction has happened within a company and you need to record the transaction, first figure out which hat you have on. Are you dealing with a receivable or with a payable? Do you have your asset hat on or your liability hat on? First, let's look at short-term or current notes payable. Notes payable are executed when we borrow money for less than 12 months or we refinance an accounts payable balance. A company can replace an account payable with a note payable. A common example is a creditor that requires the substitution of an interest-bearing note for an overdue account payable that does not bear interest. A less common situation occurs when a debtor's weak financial condition motivates the creditor to accept a note, sometimes for a lesser amount, and to close the account payable to ensure that this customer makes no additional credit purchases. I've seen that happen. A note payable is a written promise to pay a specific amount at a definite future date. Short-term notes normally bear interest to compensate the lender for the use of money and the risk of lending it. In this example, Brady owes money to McGraw. Now, we have our accounts payable hat on and are doing the accounting for the Brady Company. Let's assume that on August 23rd, Brady Company asked McGraw to extend its past due $600 account payable because it can't pay on time. McGraw agrees to accept $100 in cash and a 60-day 12% per annum, that's per year, $500 note payable to replace the account payable. McGraw prefers the note payable over the account payable because it earns interest and it is written documentation of the debt's existence, term, and amount. When the deal is completed on August 23rd, Brady debits or zeroes out its accounts payable to McGraw. It credits cash for the $100 payment it made, and it increases notes payable to McGraw for the difference. Brady is exchanging one current liability for another. Note that no interest is recorded yet because time has not yet passed, and no interest is owed unless that time has passed. When the note comes due on October 22nd, Brady pays the note and all of the interest by giving McGraw a check for $510. Brady debits or decreases notes payable for the original amount of $500. It also debits interest expense for $10. Interest expense is computed by multiplying the $500 principal by the 12% annual rate for 60 days. Finally, Brady will credit or decrease the cash account for the total amount paid of $510. Instead of replacing an accounts payable with a notes payable, let's look at a promissory note issued to borrow money from the bank. A bank nearly always requires a borrower to sign a promissory note when making a loan. When the note matures, the borrower repays the note with an amount larger than the amount borrowed. The difference between the amount borrowed and the amount repaid is interest. Notice that we have a definite payee, the National Bank, unknown amount for $2,000, plus interest at 12% for 60 days. The entire amount will be paid on November 29, the date the note matures. You learned how to determine the maturity date of a note when we talked about notes receivable in a previous chapter. So let's look at the appropriate entries. On September 30th, the date the note was signed, we will debit the cash account for $2,000 and credit the current liability, notes payable, for the same amount. Again, no interest is owed on the issue date because time has not yet passed. On November 29th, when the note matures and is paid, We will debit notes payable for $2,000 to zero it out. We will also debit interest expense for $40. The $40 of interest expense is calculated by multiplying $2,000 times 12% and modifying the result for the length of time the note was outstanding during the year. That's 60 days divided by 360. To complete the entry, we need to credit cash for the total amount paid of $2,040. If a short-term note payable is issued in one accounting period but is not payable until the following accounting period, it's necessary to make an adjusting entry at year-end to record the interest expense. A reminder of the three important dates for notes payable and receivable is shown on this slide. Let's continue with the same example, but assume instead the $2,000 was borrowed near the end of the year on December 16. Here are the facts. On December 16, our company borrows $2,000 and agrees to repay that amount plus 12% annual rate in 60 days. First, let's prepare the journal entry to record the issuance of the note. On December 16, we will debit the cash account for $2,000 and credit the current liability account, notes payable for the same amount. Now, because December 31st is the end of our accounting period, we need to prepare an adjusting entry to correct our books. We need to accrue $10 in interest expense for 2015, that is, for the length of time from the note issue date of December 16 to the end of the month, December 31st. Since there are 31 days in December, 31 minus 16 equals 15 days of interest to accrue. The entry is to debit the interest expense account and credit the liability account, interest payable, for $10. Now let's complete our example by making the entry to record the payment of the note and interest. And be careful, this one is a little tricky. The note falls due and is paid in full on February 14, 2016. We saw in the earlier example that our company owes $2,040 for the principal and interest. The total interest is calculated by multiplying $2,000 times 12% and adjusting this amount for the 60-day life of the note. In this example, the total interest of $40 is divided between the amount incurred in 2015 for 15 days and the amount to be recorded in 2016 for 45 days. The journal entry required to pay off the note plus interest is as follows. Debit notes payable for $2,000. Eliminate the interest payable recorded in 2015 with a debit in the amount of $10. Debit interest expense for $30 for the 2016 interest amount, and credit cash for the total amount due of $2,040. Use the home base cash account. How much has to be paid on this note? Then, a good way to help remember the rest of the entries: first, clean up what's on the books, the two payables, then record the additional interest expense owed for the time that has passed since the prior accrual was done on December 31st. And that's it. All done. See you soon.